Rajeev Kakar is an experienced banker and a serial business founder and entrepreneur. With over three decades of experience in the banking industry, Rajeev has worked and lived as both a Fullerton Financial Holdings and Citibank International expatriate officer in several global markets, especially in the high-growth emerging CEMEA and Asia-Pacific countries, based out of India, Egypt, Turkey, UAE, and Singapore. In these roles, Rajeev has operated large banks and financial institutions, successfully realigned banking businesses, executed multi-country business strategies, led acquisitions and transformations, and has been a founder of multiple greenfield financial services businesses and institutions. He continues to also actively serve on several prominent boards. So, Rajeev, the floor is yours.
Thank you, Manos. It's a pleasure to be here. Pleasure to be connected with the Stantonchase family. It brings me back, fond memories. In 2012, I had the honor of being in a similar session in Zurich for a similar meeting of yours, and I still remember that fondly. I remember I'd been asked to speak on a topic which at that time was how I saw the world in 2020, which was a very tough proposition. But it was like looking at the crystal ball. And strangely, this is the year 2020, very different from what we thought it would be, but in some ways very similar to what I'd expected would happen. And it's a pleasure to be here this time around talking about the journey from, as Manos asked me, from traditional banking to future banking. Well, I can't claim or profess to be an expert because I don't think anybody can be an expert in today's day and age. But I'm happy to hear, be here, share experiences, and tell you how I think the world will change as far as banking is concerned. And to be very honest, a lot of what I'm going to talk about, I feel, is agnostic to banking. It could work in healthcare, it could work in environment businesses, it could work in any kind of business that works around inclusion, anything which is high impact, whether it's technology, etc. Because what we're really talking about when you talk about the future of anything really talks about where the incumbents are going to get affected in any business and what the insurgents are doing and how the incumbents, if they have to survive, must change their approach. And on the other side, how the insurgents need to go out and get their share of business if they wish to succeed. But, over my career of 34 odd years, I have seen that there's always been an element of disruption at any point of time. We talk about disruption always being the most critical disruption at the time we are in, because we are all obsessed with the present. But change is a never happening thing, which is why the world just gets smarter, better, and sometimes it leaves us all behind. So I have to say I saw different levels of disruption, whether it was how banking changed, how remote banking happened, how phone banking happened, how mobility happened, how the internet came on, the .com came on, and thereafter we started talking about Wi-Fi, we started talking about broadband, we started talking about mobile phones, and now we're talking about cloud, and who knows in the future what we're going to talk about. The best part is the world moves in a very convergent sense, and sectors today are all interacting at any point of time. And the couple of things that I think never change is the human being. The thing that eventually drives how business moves, according to me, and banking and finance is no different, is the demands of the individual. Because the human being is really the link between the macro and the micro elements, and the micro elements of any economy. The human being and the collective behavior of multiple human beings that affects behavior that leads to the economic impacts that we see. So when I look at banking, there will be elements that will change. And I feel the what of banking will never change, but the how of banking in terms of how it's delivered is changing. And that has always been changing. And today, as we sit here and try to forecast what will happen in the next 5-10 years, I think we have to realize that the what will never change. After all, what are banks? Banks will always continue to be the intermediaries between those who have money, those who want to put money, and those who want the money to be safe, as well as those who want to borrow money, be able to leverage it, create enterprise, create jobs, create value for themselves. And how banks look at clients, that never changes. The technology changes, how you do it changes, but what you look for in clients doesn't change. So if I let you onto a secret, which is a banking secret, it's not really a secret. Every customer, be it a company, be it an individual, in banking, the banking world is looked at in terms of the character, the capacity, the collateral, and the capital that they have, as well as the conditions or the covenants that you've built in an organizational sense or a contractual sense. And these are the kind of contracts you build, but you assess people differently. And that has been stuff that has happened time immemorial. That won't change. But what has really changed in the world is because of some of the practices of past generations, some major macroeconomic changes have taken place. For instance, stimulus is here to stay. We are seeing year after year, and now for more than a decade, there's been unprecedented amount of stimulus in the economy. What does it mean to banks? It means interest rates are going to be low. It means reduced profitability. It means there's going to be a greater pressure around what you want to do. On the other side, the oil equation has changed forever, which means the traditional sources of capital, the move towards renewable energy, the move towards green finance operations, the move towards regulation, which is going to ensure that ESG practices become far more important, are all impacting how finance gets done. The third element, if you really look at, and these are macro themes which are emerging, which also, by the way, work equally for other businesses, is the fact that populations are aging. And hence, many of the solutions, be it in any industry, and banking is no different, need to start catering to people who live longer but are aging and have very different needs. So the life stage needs are getting redefined or enlarged because earlier people didn't live that long, or if they lived that long, they were not productive members of society in an economic sense, are today now becoming more and more discerning, and banks too have to transform. The fourth factor is that cities are getting extremely, extremely congested. So the need for people to be able to get services at their doorstep is impacting e-commerce, is impacting mobility solutions, the need for banks to be able to deliver at a client's phone or a client's need in a predictive manner. And then there is a burgeoning population. And as populations burgeon, and democratic societies around the world make sure that no longer are economic and financial elements driving the needs of people, but what is driving elements is also the social and political factors that affect people. So the masses at the base of the pyramid now need to be included into the mainstream for two reasons. One, if they're not, that'll lead to strife. On the other side, by getting them into the mainstream, you ensure that you create more demand in a world where demand and capacity that is being created to provide for the demand are completely mismatched. So we're talking about far more access to information, far more discerning people, a demand for greater things, internet, media, travel, everything having increased, so people are demanding things. But people are demanding things the way they want them to be given. So these factors are now driving change, and banking is no different. I want to correct a belief when we start talking about future of anything in the world today, and especially future of banking, and when we walk into the trap, I'm going to use the word trap that consultants often get banks and other institutions into, we end up talking about words like digitization, disruption, direct mobility, demonetization, dematerialization, data usage. Now, these are all enablers. These are not the changes that we should be focusing on. We should understand what is driving some of these changes. And the changes that are being driven are really that we are facing an unparalleled amount of deflation in the world. There's just too much of debt. There is demand which is outstripped by the level of capacity that exists. And obviously, there will be a lot more of debt in the world, which is constraining growth. There is a need for decision because we're talking about billions and billions of people who want things to be done. Billions and billions of enterprises that governments want to enable because governments cannot be the employers of last choice. And at the same time, each country, each economy, each continent is creating its own dynamic regulations, which are often misaligned with each other to be able to make sure that each can do better than its alternate country, the neighboring country, whether it's through devaluation, whether it's through dynamic regulation or whatever. And at the same time, while we are trying to create these differences as countries, which are unnatural frontiers, there is also a lot of dependency because we are becoming, as a world, we are becoming far more connected. So do keep these things in mind as I talk through some of my presentation points, which will help you perhaps analyze how banking itself should change. Now, when you look at banks, there is a tremendous amount of cost commoditization taking place. As I mentioned, interest rates are dropping. There is a need for scale. There is a need to deliver value. And obviously, banks that will succeed in the future are going to be those that can make strategic expense management into a competitive angle. No longer is cost minimization just a target. Cost minimization to be able to drive for the same level of expense, greater amount of value is going to be the biggest driver of ownership. The other thing that is driving the success of any enterprise, and banks are again no different, is that experience ownership is defining where value gets created. So power is shifting to people who control the customer interface. So whoever controls a client today takes a disproportionate amount of the revenue pool that a client can create for any enterprise that is serving them. In the past, a bank would handle this holistically, but today client relationships are not necessarily handled by banks because there are enough intermediaries who go out and hold it. So if you're the manufacturer of a product or service, the strategy has to be very different than one that is the owner of the relationship or the customer interface. And if this important distinction is not understood, whether it's healthcare, whether it's environment businesses, whether it is banking or it's education or any other business that you look at, there will be a mismatch and fundamentally such institutions will not be able to survive. And again, in banking, we have to realize that over time, banking has used a lot of technology and partnered with big tech companies to be able to build their systems for them. But in the process, these very companies that have created their technology for them have intelligently, smartly, and outside the regulatory system been able to learn from them and have taken away the customer experience ownership capabilities from banks by creating their own asset-light businesses or the non-traditional channels that can today serve customers. Now, obviously, when you're heading towards what I'm talking about today is a lot of commoditization, there is a need to make sure that you deliver service to a large number of people predictably, reliably, in a high resistance fashion, in a very capable position at a low cost to be able to be profitable. And so there is emergence of automation, there's emergence of robotic services and a whole bionic workforce, which is eliminating individuals for several of the jobs which are repetitive, which are transactional in nature. And in the process, it is taking away jobs, but it is also driving a huge amount of speed and efficiency in the business. Now, all these elements are extremely important in terms of determining how banks will transform in the future, in terms of its workforce, in terms of how they do its business, in terms of how businesses get unbundled and banks get unbundled. And at the same time, when we're dealing with such large customer bases, as you go lower down to the base of the pyramid, the size of transactions becomes so strong, which in the erstwhile era were not getting serviced because they were not just profitable enough to be serviced. And now these segments are important from a social standpoint, but they're also important to be able to bring into the mainstream so that you can drive the kind of value that you want to create for the institution by expanding your target market and making sure that there is a price point of service and a price point at which you give value and at the same time you transact value to be able to deliver. So I'm really talking about huge amount of inclusion, whether it's on the SME space, whether it's on the individual space, whether it's on the microfinance space, that is going to be driven. And strangely, and actually not strangely, regulators themselves want to do it because that is an important social objective that every political party, every government in force, or every country needs to develop. Otherwise, crime, capacity and demand mismatches, and the need for greater social upliftment or fiscal stimulus will just keep dragging down economy after economy. And as you get into more and more unsophisticated customer bases, there is a need for greater regulation. So we're talking about an extremely complex space where you're dealing with people's money, where you're lending to people, where there is a need and dependence to be able to make sure that you handle things responsibly while being able to do things in a high speed, high dependence, high competence, high error, reliability phase, and yet not make errors is going to drive how the operating model of banking is going to change. So what really is happening in banking? Traditionally, banks believed in investing hundreds of millions of dollars in technology, making sure that clunky systems were built. And these clunky systems were built so that you could process transactions, do things, and handle literally as many needs that a client would have possibly and be able to provide for them. It was possible in a world where we were really servicing the upper end of the pyramid or even the middle end of the pyramid. But as you go deeper and deeper down, that is just not possible. And the very manner in which banks have been built over the years by building clunky systems, which ensured that you could, as a single bank, try to project yourself as a solution provider for all the needs that a client could possibly want or request for from a bank, be provided by a single institution, has completely changed. And what has happened is that big techs, etc., as well as the convergent disruption process that is taking place, the experience ownership is shifting to people who are able to build the relational capital with the customer. On the other side, banks themselves are trying to retain control over the client, but they're not able to do so because the cost of servicing them is becoming extremely difficult. So where are we headed? Banks, if they don't transform or change, will become mere utilities. And fintechs or non-traditional banking models or neobanks, as they call them, are just going to come in as natural disruptors and work at unbundling the bank. So what these institutions do, they use technology, they use innovation, they're often not regulated. They reimagine the journey that the client is looking for in the experience that the client really prefers, and builds it in the most efficient manner and takes over the customer relationship. And laws have started emerging in different parts of the world where the ownership of customer data is shifting away from institutions to individual customers themselves. So automatically, since the power of being able to allow your customer data be leveraged by a provider of services that you like or you prefer, and be it a player that may not be a bank, leads to a situation that there is a pressure on banks to try and resist the unbundling of services that are being caused. So if a bank is smart, instead of trying to fight this change and trying to create innovation using clunky infrastructure or using clunky systems, which fundamentally are not designed to be able to assist in innovation, actually these impede the process of innovation. They have to learn to unbundle themselves. Now that's expensive, because if you're a bank that has spent a lot of capex over the years of the nature and amount that you've talked about, it does mean that you have to transition out of something which you've worked on before. You have a set of people who are incumbents within an organization who want to protect their jobs and start breaking up what you've created. It is a mindset change which requires a significant change at all levels, whether it's a board, whether it's a senior management, or it's even the people and the skill and the talent, and as well as your operating model is in terms of how you operate. But what was earlier built as a barrier to entry has today become an impeder or an impedance to their own ability to innovate. And so banks have to change the model. And banks that have not changed the model, and largely banks haven't been able to successfully change it because they have legacy issues. If you start analyzing the amount of economic return versus normal profit that banks have delivered over the years, there is a steady decline, because a large part of the economic capital has been redistributed to non-traditional players who have taken it away. Now, this is a serious situation, because if we keep doing this, at some stage, the risks that are resident or residual in a bank will not be economically priced. And should there be a crisis of the kind that we saw in 2008, or what we're experiencing to some extent in 2020 as we speak, will put pressure on banks. And when you have a bank that is under pressure, you automatically have a lot more social pressure on institutions and governments to be able to go out and bail them. Now, depending on which side of the equation you're on, if you're a depositor or you're a borrower, you will always have some kind of a bias in terms of how the governments will behave. But governments often find it, and actually almost often find it very difficult to let a bank fail. So we're moving into a situation where banks have to relook at their role. Banks are extremely important, as this crisis has shown, in being the transmitters or the transmission mechanism of all the stimulus and other measures that relief measures that governments have tried to provide for people at this point of time. And they've done it pretty successfully this time. Thankfully, after 2008, the levels of capital, the levels of liquidity, and the levels of controls, etc., have ensured that banks this time around are not the creators of the problem, but this time around have played a constructive role in helping solve the problem. Now, that's the responsible act that you want banks to handle. But if you look at the customers on the other side, they want services in a very different way. Each customer today has a different stage of mind. We're probably several of us on this discussion today. Each of us have different experiences, different attitudes, different perceptions, different beliefs. We may be very similar in a demographic sense, very similar in an experience sense, very similar in what our beliefs and education and experiences are. But how we want things, how we want the experience to be delivered is very different. So the entire challenge for banks today is to be able to decode the customer's mind. Again, as I mentioned, this is not just a banking challenge. This is an e-commerce challenge. This is a healthcare challenge. This is an education challenge. And 2020 has hit the disruption switch in such a way that for a change, while some of these solutions were being offered in the past, but were not being adopted by clients as easily, the change has now happened at an exponential speed. So how should a bank react? Either a bank has to understand that you've become an incumbent and will not be able to survive, or a bank has to desire to make the change and change out from its core and lead out and become an insurgent in itself. So banks that are insurgents and at the same time being able to predictably handle what they are fundamentally required to do, that is provide governance, transparency, accountability, look after money safely, make sure that people can feel safe and trust their banks, are going to be the most successful. Now that's a tall order. One side is the yin of the business and the other side is the yang of the business. The yin and the yang often work against each other, but together they make a whole. So in short, as I've indicated, I think what we're going to see is an unbundling of banks. So everything that you've seen about single banks trying to provide for all the customer needs will now need to break up and unbundle themselves and understand that a lot more value will have to be built through partnering, becoming a part of the larger ecosystem, and realizing that certain services have to be not necessarily manufactured by themselves, but customer ownership, whether they want to own it or they want to be part of a platform that a client wants to be in, is the call they have to make. Or is it going to be a hybrid system by which they operate? So I feel banks will completely change in terms of the front office, middle office, and back office. I know I'm talking to Stantonchase, all of you are people experts. Everything that I'm saying here will have an impact on the kind of financial services professionals that we will see ahead. And some of the jobs that have been traditionally held within banks, I believe, will now move away from banks because banks will have to partner with specialists. And as I say this, I think the front office will have to move away from necessarily owning all that it provides and understanding that it is not often always important or possible for it to manufacture and yet be able to retain and provide for the needs of the client. So front office responsibilities and skills are going to be one where people are going to be bright, outward looking, imaginative, intuitive, innovative, and creative, so that they go out and look at how to find, even if they're third-party solutions, to be able to provide for the customer's need in the best possible way. Reimagine customer journeys. How is it that John Doe's, different people across different worlds, different segments, different ages, different economies would like the same service delivered? And what are the life stage journeys that they'd like to participate on? How do they go ahead and access the services? And this changes. It just changes by age. It changes by level of awareness, the level of travel, the kind of lifestyle you lead. And this is where bridging interfaces with third-party players, making sure that the customer journeys that you imagine are often provided through other specialist players, creating the interface between the bank, bridging them in a secure fashion, and being a part of either abstracting your own products, services, and embedding the financial services and solutions into the journeys of other third-party platforms, or creating or partnering with people that who are capable of providing the experience into the bank by bridging the interfaces. So in other words, just to give you a very simple example, if you go to a hospital, you don't need to look at the financial transaction during the hospital and the medical services, but you kind of integrate it in a manner that once you go to the hospital, your relationship is that with the hospital, treat the hospital like a platform, and the ecosystem of insurance, banking, finance, cards, payments, and everything else that goes through it gets automatically handled through the single relationship. Not by swiping a card, not by doing things, but just your single relationship ID connects in a single app platform through all kinds of APIs to be able to solve the problem. The most efficient bank that can embed itself into as many journeys and as many platforms in a successful way and abstract the services into the journeys will be successful. The banks that will be most successful in the front office and be the biggest value drivers will be those that create their own identity or their own customer relationship as the source identity through which the client accesses third-party platforms. So the front office will be a very different level of skills that will require imagination, bridging, partnering, and the capability to be able to bridge the services and create secure interfaces. The middle office and the back office functions of the banks are going to change dramatically. We have to remember that if I look at it from a Maslow's hierarchy, the front office is really like the motivators, and I've already described them. But the hygiene factors that we often disregard, but are very important for our success or very often for our behavior, because we assume hygiene factors get taken care of. And only when the hygiene factors get taken care of do you start looking at the motivators are very important. Now, banks have an advantage as far as middle office and back office functions are concerned, because banking is regulated. The core banking arrangements, the licensing arrangements, etc., lie with banks. And that is the point of importance. So banks will have to necessarily understand that as they try to avoid the levels of commoditization using creativity in the front end, they have to look at the middle office and back office capabilities by building hyper-scaled, hyper-focused enterprises to be able to fine-tune some of the elements of risk management, asset liability management, treasury management, governance, compliance, regulation, oversight, etc., in a manner that is so predictable that people can feel safe with their money there. And governments will also expect that of them. And so this approach has to move away from one of expense minimization to an ROI focus or a return on investment focus. We will see greater level of mergers and acquisitions. Banks, for them to be hyperscaled and with new non-traditional services coming in the front end, we don't think we will need as many banks as we've had in the past. And you're seeing a lot of consolidation happen in most economies because banks cannot afford to be subscale anymore. Bank profitability is at risk. And at the same time, regulatory oversight is at great risk. So there will be greater hyperscaled institutions which will form in the middle office and the back office functions. When you look at the middle office and back office functions, again, I expect that there will be a four-level segregation, depending on the level of customer impact as well as the level of service availability in a standardization sense in the outside market. So banks don't have to necessarily produce everything even in the middle office and back office. That's another significant change that we will see in banking. And that will change the kind and quality of people that you need in the middle and back office. I don't think necessarily that everyone who works in a bank is a banker in the first place. I think banks have 60 to 70% of people who work in banks who really don't need to be in banks. In fact, they need to be working in centers of excellence that are important for them to be a part of, to be able to get the skills that banks are not good at. For instance, if you're in technology, do you need to be in technology infrastructure within a bank? Do you need to be in transaction processing within a bank? The answer is no. So if you break up these activities around the two dimensions I mentioned, you can segregate them into four different areas. And the reason I say this is because banks will have to, in the future, prioritize what they do within and where they will partner outside for middle and back office functions. And where an activity is high on customer impact and low in the level of standardization in the market, or something which I would call a crown jewel, like credit judgment, how you make a decision, treasury decisions, etc., risk management. These are really the judgment-intensive businesses that you go to a bank for. And one bank is better than the other bank because it makes better credit decisions, better risk management decisions, better liquidity management decisions, better capital management decisions. And this is the core skill of what bankers have. These should always be resident within banks. But if you look also several activities which are very low on customer impact, but high on standardization, like transaction processing, data entry, documentation scanning, etc., which tend to be in banks, but have no business to be in banks and need to go into BPOs and other public market infrastructure, which is more standardized and becomes more cost effective and helps drop the cost of banks. On the other side, you have functions within a bank which are low customer impact, but at the same time, high level of and low level of standardization. And these are functions like audit or some of the control functions. It doesn't have, customers assume that there will be a control around it, but they don't really get impacted by the audit that goes within it. And that's where you start partnering with people who are specialists around that and having some of these functions within the bank. So that itself will change the level and the kind of skilling that you need within a bank. And then finally, of course, are those which has a high customer impact and a very high level of customer standardization, which is functions like sales and marketing and analytics. And some of these things, these can be outsourced to specialist partners and or with platforms or other capabilities, etc., that can help bridge these interfaces rather than the banks having it. So what am I suggesting? Banks don't have to be large in population anymore. Banks have to move away from a concept of headcount to FTE. I mean, you may have people working for you through other agencies, but working in specialized entities. Your technology infrastructure can be outsourced. What is important in the future is to realize that customers no longer need products. Customers need customer centricity. They need holistic solutions. And two customers of the same background may not have the same level of need at any point of time. So there's a need for a greater level of predictive thinking. And I speak not just for individuals, I speak for SMEs, local corporates, multinationals, and what have you. And so there is, whichever part of the business you're in, there is a need for us to start understanding that you cannot provide as a bank for all the needs. And there is a need for a platform thinking. And what really are platforms? And today's technology has made platforms get connected to each other. And this change really started over the last 18 to 20 years, and partly has been aided by some of the technology tools and the data tools and the availability of broadband, mobility systems, smart systems, etc. That has led to a load of data being created. And now for a change, that data to be collated, and then for a change for this data to be analyzed for people to use in a predictive manner and make decisions. So when you become a part of the ecosystem, open up your APIs. Now, this is the kind of language people often talk about, but this is as a result of some of the macro changes and evolution that banks have to be aware of. Then the products and services of a bank need to be moved in a four-step process. So banks will still need to manufacture products, but then make sure that these products are stacked against customer segments in terms of their needs and have a segment-centric strategy. Thereafter, place it into the marketplace, but use intelligent solutions to be able to make sure that those elements of decision-making which are predictive in nature, which need fast decision-making, or need automated tools of straight-through processing, robotic process automation, etc., get done automatically. So if you're doing an invoice discounting, or you're issuing an LC to a client that you've already underwritten, or even when you're underwriting clients, do you really need to look at voluminous pieces of paper, or can you pull out data from available sources and be able to analyze what a client really needs? And once you're in the marketplace, become a member of the larger ecosystem. And the ecosystem here is really platformification of all your services and products. It's like a massive mall where you're competing for the customer eye at any point of time for the needs that he needs. And the good thing about finance and the not so good thing about finance are that it's needed everywhere. On one side, finance and banking are critical to ensure safety, transparency, and fairness. On the other side, money flow is core to any kind of good flow. So this ecosystem orchestration, if I may call it, to make sure that your product as a bank gets positioned for a client's need at the right point of time, at any point of time, be it a multinational client, be it a corporate client, be it an individual, a small business, or a commercial client, or even people at the base of the pyramid, needs to ensure that you can understand and decode the customer in a live fashion. And that's where data capability is important to activate your ecosystem. And today's ability to track a person through his locational data, his transactional data, his search data, his behavioral data, and I use the word, I use the term his, not in a gender sense, but his or her, or even if it's a company, really leaves a footprint of data for banks to be able to work very aggressively using cognitive skills, using artificial intelligence, using data and other analytics-based techniques to be able to identify what is needed at the best time. And then to understand that not all these services need to necessarily be provided by the banks themselves, but they can well be provided by third-party players. So you have to integrate your offerings with those offerings that you don't wish to manufacture, or those that a bank cannot regulatorily manufacture, but be able to combine an interface and be able to provide it in the best way. So what I'm really saying is split the activities of a bank into one of intellectual capital and one of relational capital. Now, intellectual capital is really the judgment-intensive businesses or the functions that a bank provides, like a doctor in a hospital. The doctor's skill is used to be able to provide how he or she is going to diagnose the ailment of a patient. But in how the cure gets administered is really the transaction end of the business. But the diagnostic end is the intellectual capital. And this is where banks would differentiate themselves. But on the relational capital, to make sure that the marginal cost of providing incremental services, or to be able to make sure that the bank services are positioned first or before another bank's services are offered or made available, is really the skill that is going to work in a very predictive manner. So what is the bank of the future going to look like? I know I've been talking about a lot of things. I think the bank of the future has to focus on delivering impact, on driving inclusion, and at the same time, leveraging a lot of innovation. Because this is extremely important. The world today will not be willing to allow banks to be elitist or ignore a large majority of the people in the mainstream. Now, what that does mean is that any amount of innovation that a bank produces must leverage new segments of customers. So the traditional approach of trying to go after the same set of customers and ignore a larger part of the stakeholders can no longer exist. And so financial inclusion for the unbanked or the underbanked. There are several of us on this call who might be underbanked without realizing that we may be banked, but we may be underbanked. Are we truly getting a unified experience for all our services? Is it true that you can, through your single relationship, go to one bank and be able to, or one identity, and be able to provide for all your needs? And the answer is no. So obviously, even if you're banked, you're severely underbanked. So there is a need to integrate people and get them into the mainstream. On the other side, the reality that we have to face is the world is today realizing the importance of the gig economy. And so any business or any operational model that banks build must also leverage for their success to be able to operate more actively by leveraging the gig economy. The opportunity to partner. Banks will increasingly partner to build robust, scalable, and profitable models. At the same time, use these partnerships and the use of tools to be able to create value that helps them differentiate against. At the same time, complementing the core capabilities that a bank must provide, that of an intermediary, that of a safe provider of services, a safe provider of finance, while keeping money and practices safe and while treating customers fairly. So that's a lot. Impact, inclusion, as well as innovation. So for that, we have to understand what clients really want. So you can get very technical about products and services, but what does an individual want? I just talked about it, a unified set of services available through a single relationship, whether it's manufactured by Bank A or Bank B or by any other provider. The intent is that you can get a unified set of experiences that helps you improve your quality of life. And if you're a business, what do you wish for? A single unified experience through a single relationship ID through which you can access a bunch of services, either manufactured by a bank or even a third-party bank or any other survivor or any other provider in a manner such that you can conceptualize your business better, develop your business better, be able to get support for its development and be able to succeed, raise capital, get capabilities, and be successful, and be able to employ more, invest more, and grow more. So I probably disappoint some people when I talk about the future of finance because I don't spend a lot of time talking about technology, because for me, technology is definitely a requirement. Data is definitely a requirement, but it is something that is core as an enabler. It's not the end state. So if I want to demystify the future of anything, or even if it's the future of finance, I think the important thing to understand is a founder's mentality. We need people now, and you people are the people managers, where we build talent, culture, help rethink organizations, reimagine customer journeys, reshape the culture, and rechange and redesign the operating model of banks. Bring in customer centricity, allow for competence, capability, specialization, at the same time a relentless innovation drive. So I think digitization, tools, and systems are just enablers. What is really important, and it's the time to awaken. It's an article I've written, which I strongly believe in, that the future lies in the hands of people with knowledgeable minds. M&As will happen. So you will see greater mergers and acquisition banks. That's a big future. You'll see fewer banks. And eventually, my belief is that we will not see banks. Once we get digital currency and physical cash goes away, accounts will be held with central banks, and neobanks and non-traditional channels will handle the future ownership. And that can happen 10 years, 15 years, 20 years from now. And digital currency is almost necessary for reasons where physical currency, which is very expensive, goes away. But it also serves the important thing that governments are looking for: negative interest rates. If the government's in a state where stimulus is going to be consistent, interest rates are not going to be high. If stimulus is going to become a regular feature, the only way governments can drive negative interest rates is by moving to a complete digitization of currency. I know it's a little hard to accept today. It's hard to think of, but the only way people will not physically store money in vaults and avoid the negative interest rates is when there is no physical money to support. So finally, all I can say is, what will our bank look like in 2025? Since I said I was trying to predict what the world would look like in 2020, I'm going to suggest how I see them. I think the banks will still be what banks are today in terms of the what. But the how will change. There'll be far fewer branches. There'll be far fewer people in the bank as the way we see them. You'll find far nimbler people. Banks will be focusing a lot more on hiring. Careers in banks will become shorter. banks will look at reskilling, but upskilling is going to become a thing of the past. I don't think banks have the luxury to keep on with older stuff. I know I sound a little tough on this, but I think banks of the future will have to reskill and constantly hire, because as people change, new ideas come, new innovation comes. It is very important to get a certain level of skills. At the same time, through the specialist centers of excellence that it uses to partner, there will be a greater level of customer centricity. Banking services will get unbundled. Innovation will be driven to the highest level. Banks will get hyper-scaled. There will be high customer impact businesses lying within. Branches will be fewer, and banks will be a lot more safer when you look at them in terms of capital, liquidity, and keeping your money safe. So I've tried to encapsulate how things will change. I've tried to bring a people element into it, because I'm sure all of you are interested in what happens to the people, what happens to the kind and quality of talent that comes in as a result, because these changes by themselves have a direct impact on your line of business. How you source people is going to change. The kind of people you need is going to change. By the way, the kind of consultants and the training consultants have to go through to be able to assess whether some of these people are really good for the challenge of banks, or which part of the bank or the unbundled bank that they need to be themselves will have a learning curve for even executive search firms and people firms like yourselves in a big way. I'm not an expert on that industry, but I do have to say, having handled people, the biggest thing that is going to drive the future of banks and the success is going to be talent. And that's the only thing which I believe is the effective tool to disrupt the status quo at any point of time, because creativity and innovation is required to disrupt the status quo. Tools will always be available, and the tools of the future today will be tools of the past and the future. So I believe in the ingenuity of the human mind, and I've seen that always surprise me. So that's my initial bit. I'm happy to take questions. I've been
Thank you so much, Rajeev. Thank you very much. You always bring great value to every discussion. Thank you very much. Of course, we spent more time than the budgeted one, but
I'm sorry.
It was our pleasure to listen to all that points. It was our pleasure. Great. So I think that we should start the Q&A session. I would like to raise the first question. You know that board advisory services is one of the important, let's say, business lines of Stantonchase, and a challenge for the future. What is the role of boards in managing this crisis of change that banks are facing from a move from traditional to future banking?
I think the roles of boards has completely changed and will only become more and more important in the future. Boards are no longer going to be some of the tacit boards of the past. I think boards today have to play a far more aggressive role, a far more proactive role in helping drive this change and in changing the mindset. And which in turn will also have an impact on the kind of board member staffing that boards will have to bring in. Firstly, people with an international mindset, especially when it comes to bank boards, because banking is not domestic business. You know, if the interest rates or the elections on November 3rd will impact what can happen in Europe, it can impact what can happen in Egypt, India, in Asia. I think boards also have to challenge the teams to think big, do zero-based planning, realize that you have to strike a balance between the future potential that exists and where the current is being paid for. In other words, the performance versus the potential. Boards have to very aggressively make and challenge management to not get complacent about staying with their current models, but actually encourage them to work towards a new model. Ensure organizations can navigate the ambiguity, make the investment, and pivot faster than its peers. Financial inclusion, focusing on new segments, making sure that self-employed businesses, etc., that can drive some of the social objectives are very critical, because governments will insist that banks as transmission mechanisms, traction mechanisms, make sure that part of their capital goes towards those elements of the economy that will make the economy more productive. I think boards also have to focus a lot more on resilience, and this has come out because of the COVID crisis. The need for resilience, the need for being able to handle things super fast and face any kind of catastrophic situation and not fail is very critical. Almost in every crisis before the 2020 COVID crisis, banks have always contributed to the problem. This time around, banks have actually played a constructive part. So encouraging participation in a connected economy, making sure that you don't put your head in the sand as a management and be comfortable with what you do in the future, because what you do in the present. Because every management is also an incumbent management and often tries to resist change. A readiness for acquisitions, because scale, as I mentioned, hyperscale is going to be very important. Culture. Boards have to shape culture. Boards have to allow managements to go out, innovate, and create a culture where you can do a can-do approach, but at the same time where it's safe to fail. So, establish boundaries where it's safe to innovate, safe to fail. And finally, I think build complementary skills, understand what you can build within the bank and what you can partner. Be open to ideas, be open to realizing that sometimes there are things that the company cannot do, and it's okay to tire. And finally, to build out openness to change, to drive diversity. And I don't mean diversity just on a gender basis, but also diversity by making sure that we accept that there are flexible work arrangements, which 2020 and the COVID has generated. So flexible work arrangements are going to become a reality within banks. And that is a big challenge for banks because control is an issue, security is an issue, information security is an issue, making distributed systems and making them be controlled and manage regulatory requirements is an issue. And hence banks, boards have to help banks realize that no longer do you have to manage people by looking at them, managing them physically, but manage by result. So these are mindset changes that I think boards can drive. And obviously, Manos, what we need is far more capable business driving board members, people who have realized what it means to really run a business, people who can handle oversight and yet drive change, people who can influence leadership. Those are the kind of people that we need. And again, talent at the board level will really drive value for banks.
Thank you, Rajeev. Thank you. A question coming from Christophe. You mentioned that most banks have not been able to change, mainly due to legacy issues. Could you elaborate? Is it a matter of not having the right leadership, not having the right people on board to lead the change, or more no access to the right technology, or maybe other reasons?
I think it's a wonderful question. I believe that the solution is not in not having the technology or the products or the solutions, because they always exist. The issue lies in a combination of the talent and the team spirit and the ability and openness to change. We have to move away from the lipstick effect or the effect of just talking about digitization or doing the cosmetic element of, I'm digitized and I'm open, I'm willing to share, but actually not share. It needs an importance to understand that you have people who lead the transformation of the bank. If you break up the activities in a bank, which I call run the bank versus change the bank, the change the bank people have to be very different. They have to be freed up from some of the constraints of what is required. They have to be open to working in a far more agile ability. So I think the common enemies are a combination of culture, lack of talent, and often taking the easy route of just going out and hiring a consultant. And consultants, I have to be careful, but I do say that if consultants haven't themselves, they end up doing what they're most successful at is driving their own business by selling their time. Because the more time they engage with, the more stuff they build to the client, the more money they make for themselves. And not all consultants are not good, but I think eventually the talent within a bank should be able to drive value from these consultants and generate its own capabilities and understand what its strengths at the core are. And that's where most banks have failed. And finally, the other constraint, of course, is the challenges that banks are facing today. Profitability of banks, because of is really down because of stimulus, interest rates being down. Whenever interest rates are down, banks don't have the ability to invest. So the ability to invest itself constrains your ability to change. The level of competition is very high. So the level of competition with talent is very high. The kind of culture you have within is not easy to change overnight. So some of the top-down cultures have to change. And very successful CEOs who are very dogmatic, etc., or who have controlled people have to realize that they have to make a change. Otherwise, you will drive away people who are innovative, people who are able to make that change. There's also a lot more growing competition, and competition no longer just coming from banks, competition which is now coming from non-traditional channels. Even CFOs within banks are now disintermediating banks and reaching out capital markets directly. And of course, customers. I think the most important element is that customers are not willing to take substandard service, irrespective of where you are, substandard solutions. And customers are far more discerning. There's far more access to information. There's far more choice. And when you're operating with so much change, when you're operating with so much capacity, and you're operating with an inside culture and the lack of talent, it becomes difficult. So often those are the reasons, but not because of the absence of technology and tools. And just because you have technologies and tools doesn't mean you will succeed either if you don't know what to do with it.
Thank you, Rajeev. Thank you very much. An interesting question coming from Carlos. How do you see in the near future the relationship between big banks and fintechs? Competition, collaboration, or both?
Well, as I said, the role of big banks and fintechs is essentially one of an insurgent versus the incumbent. The collaboration that, I mean, the relationship that I see, which is constructive, is one of collaboration, and which is what I've tried to say. So when you look at the fintechs, and I treat them as part of the front office that are taking over the customer ownership, or they're taking over some of the business that the banks had been traditionally doing, I believe that it is pointless trying to fight them. It's pointless for a big bank trying to acquire them. That's one M&A I don't want to see. I wouldn't want to see a bank going out and buying a fintech, because you end up paying value for something that you will end up destroying yourself. Because fintechs are innovative, they have a can-do culture, they find it safe too, they're nimble. But the moment you become part of the bank's fabric, you're unable to do that, because innovation is stifled to some extent, because there's compliance, there's regulation, there's a lot more process control, landscape, etc., for good reason. So regulation is good, but regulation may not help you be as innovative. So I think the need to partner, the need to collaborate is the way to succeed. The need to the bank that is most successful in creating as many collaborative relationships and build its relational capital versus its intellectual capital will ensure that it not just makes profit but makes economic profit. Banks that ignore the relational capital that a fintech and non-traditional players can bring and shuns the idea or delays the idea of being a part of the connected economy will just lose out the healthy sliver of economic capital on the top and will make normal profit. And normal profit is often not able to account for shareholder expectations, returns, and even unexpected losses that a bank may face at some point of time. So if you have to generate alpha, if I use financial terms from a market standpoint, then collaboration is the answer, because there is just no way banks can insource that level of innovation or be able to imagine the customer journeys with the kind of discerning minds that consumers, customers, and small companies and businesses have. And that's where the opportunity lies.
Thank you, Rajeev. Another question from Jan Bart. Is it not already too late for traditional banks with players like Tencent, Rakuten, Alibaba, etc., who provide all those services across mobile platforms integrated with all kinds of other services around lifestyle, shopping, entertainment, health, etc.?
I personally don't believe it's ever late. I'm not a believer in the first mover advantage because I myself, having built businesses in markets where we were often not the first, not the second, but often the 25th player, have been able to become the first and the best. I believe the real power of succeeding lies not just in the fact that you're first, but lies in how you execute against the journey. And the other reality in the world is that whatever business you're in, there'll be changes at any point of time. The ecosystem changes all the time. The level of, the system that I talked about initially, and I shared with you some of the global forces and the macro forces and the customer behavior changes. These are constant changes that take place, because the human being is really the link between the macro and the micro element. We have to remember that the Ant Financials and the Alibabas and the Ping Ans and the Amazons of today, which are considered the insurgents today, will be the incumbents of the future, just like the incumbents of today were the insurgents in the past. So this is the natural law of transition. It is never too late. As long as any player wishes to decide that they want to go out and succeed, you equip yourself with the right attitude, the right culture, the right people, the right founders mentality, the right level of empowerment, and go out and use innovation and understand and decode the customer's mind, create a proposition that's unique, leverage on the attitude and actions of clients, because there's enough capability and enough railroad that you can ride on in today's connected economy to be able to make a difference and disrupt. And I can give you example after example. When BlackBerry was found, people thought this was the end of this is the ultimate solution. It didn't survive. Smartphones came in. And when smartphones themselves are continuing to succeed, they'll soon become passé if they don't get into services which are very different. So Apple, by its own admission, has mentioned that by 2025, it will be known as a healthcare company. Ping An, which started as an insurance company, has moved into housing and healthcare. Apple has moved into financial services, tying up with Goldman Sachs and credit cards, personal loans, tied up with the Amazon network. Amazon, which started as a company that was just selling books, is today practically competing with almost anything that you're looking at. Reliance Jio in India, it was an oil and hydrocarbon old economy company, is transforming itself completely into the data technology, retail, customer-centric, telecom-linked company. And over the last 3 months, it raised more than $30 billion by getting some of the largest investors in the world, including companies like Facebook, etc., to come in and invest with them. So the power of owning the customer ownership, and customers themselves make a choice. Instagram versus Facebook, the lack of Google Plus. Apple has come out a few days ago and launched its own search capability, which will try to take on the Google search capability. So there's always a proposition with a difference where the incumbent will be at risk with the insurgent. And that is a law of nature which will always provide greater opportunity. And which is where the ingenuity of the human mind and the availability of smart tools enablers will make it easy. The good thing in the world today is that there's enough railroad available. What we've achieved in the last 10, 15, and in recent years especially, is the connectivity of the shared economy. What has also been created of late is the gig economy, which suddenly makes the power of one person being able to serve multiple people, or one platform being accessed by multiple institutions, of institutions being able to use each other for services, microservices being developed. So what has happened over the last 10, 15 years is a tremendous amount of enablement of just like the World Wide Web was created a couple of decades ago. Today, you've got almost like a World Wide Web of business platformification that has taken place. And now ingenuity would ride on top of this platform and create new value. So I don't believe it's too late. I believe this will just lead to greater ingenuity, new innovation, and new levels of insurgence coming. And the moment you become big and large, you become incumbents in your own mindset. If you're on the organization, on the incumbent side, I think the challenge is very different from that of an insurgent. Keep changing itself as distinct from running its business. So as I said, run the bank, run the institution versus change the bank, change the institution functions are going to be critical. But it is going to be a constant process of shift.
Thank you, Rajeev.
And careers are going to be far more shorter in the same institution than ever before.
Just one more question. There are too many questions on the chat room, but we don't have enough time. Unfortunately, we could spend here more than 3 hours together, Rajeev. Everything is very interesting. A question coming from Remco. Remco, do you believe there are specific products or services where banks will not be increasingly challenged by new and more selective entrants?
Yes, I think wherever there is, as I mentioned, what I call middle office, back office, regulated services, I think will always be the core advantage by law and be controlled by banks. So there will be fewer and fewer banks, but banks will remain owners of the core responsibility they have in making sure that the money you keep of customers is kept safe, is kept with the highest level of integrity, highest level of care, the best levels of financial risk, treasury, capital, liquidity management. Making sure there's governance, making sure that information security, etc., is protected. Now, these are core controls which, if left to big tech, would get out there and open and get disrupted. But whenever there is a regulation, and regulation is, I feel, necessary, because in the lack of regulation, we'd be living in the jungle. These will not be functions that will necessarily be an attack. However, how these functions get administered will change. So you are already seeing the emergence of microservices, or you're seeing elements of the middle office, back office functions of a bank, which are core to itself, becoming where the customer impact is low, but the level of standardization is low. And I'm talking about things like AML. I'm talking about things like audit. I'm talking about regulations. These are going to get platformatized themselves and driven by the. They will be core where all banks will become participants to creating what I would call a value system and building financial market infrastructure. Example being regulation as a software, banking as a software, AML as a software. So instead of having different AML practices or KYC practices or e-KYC portals, where every bank creates its own level of interface, some of these specialized entities, which are very core to providing some of the core benefits that a bank provides to its clients, will now become part of a shared infrastructure, often involving the regulator themselves. So that if you're talking about regulation as a service, these are now becoming standardized platforms where the regulator interfaces directly with the platform and the banks link into the same platform, and regulators simultaneously assure themselves that there is a common access of information, common upgradation of skills and talent, and even the regulators can pull data if they wish to be able to have greater oversight and oversight over clients. The same goes in AML, KYC, e-KYC portals. These are now live, not in all markets, but will get increasingly live. So these will become the critical parts of financial market infrastructure, which will enable banks to always succeed more and more. And banks can have a greater amount of value investments in building this kind of center of excellence or domain expertise, at the same time creating better bridges with the regulator, in order that in a very efficient manner, you can provide the greater level of comfort and confidence in a competent manner to the client, who is the ultimate beneficiary of the service.
Thank you very much, Rajeev. Unfortunately, we cannot take more questions, so we don't have enough time. I believe we learned a lot from Rajeev today, and we thank you very much, Rajeev. Our session